Less than 3% of those who are seeking capital for new projects from traditional lenders receive full funding. But with CIG Capital's 100% project funding model, we're able to meet the lending needs of projects in over 200+ industries, such as renewable energy, infrastructure, commodities and materials, government projects, hospitality, commercial real estate, and many more. CIG Capital is able to serve an array of industries because the 100% funding model supports the project from the early stages and through each step of the process until the project is completed. As the originator and note holder of each project, CIG Capital is able to bring the majority of the capital stack under one roof, including but not limited to the initial seed money, startup funds, bridge or mezzanine, construction, equity, and permanent financing. Let's take a moment to better understand the capital stack. The financial term capital stack consists of the total capital invested in a project. Now, let's break down some of the most common layers that make up the capital stack. The first is seed money, also called seed financing, referred to as such because it is money raised by a business in its infancy or early stage. Next is startup funds. Startup capital may be provided by venture capitalists, angel investors, banks, or other financial institutions, and is often a large sum of money that covers any or all of the company's major initial costs, such as inventory, licenses, office space, and product development. Bridge funding, as its name implies, bridges the gap between your current financing and the next level of financing. Another layer of the capital stack is called construction loan. This is a short-term loan used to finance the building of a project or development. Equity capital is funding provided by people or firms who want to own part of your company and reap some of the rewards when your large and successful company goes public or is acquired by another larger and even more successful company. And finally, permanent financing. Permanent financing is the funding of long-term infrastructure, industrial projects, and public services using a non-recourse or limited recourse financial structure. So how can CIG Capital take on most of the capital stack? CIG Capital's creative approach to project finance encompasses a mix of structured finance, derivatives, traditional finance, and equity. Our efforts foster and create a pioneering approach to project lending by creating an optimal balance of risk and reward through the CIG Capital 100% funding model. Where most financial institutions typically like to see a balance between a lower debt and higher equity position on the projects, CIG Capital's model is different. We measure the assets by looking at future cash flow, contracts, and future valuation. For example, the average inflation rate is approximately 2.5% over the last 60 years. Having long-term debt is usually measured as a negative on a balance sheet. But with the CIG Capital's funding model, we're leveraging all futures to create new projects today. And to mitigate our risk while supplying 100% of the project funding, collateral is required for every project. Collateral acts as a form of protection for CIG Capital. If the project or borrower defaults on the loan payments, CIG Capital can seize the collateral and recoup its losses. Collateral needs are determined by the type of project, the loan itself, the term, and the risk CIG Capital is taking. Some of the accepted collateral types may include debt instruments, credit enhancements, future contracts, offtake agreements, bank guarantees, letters of credit, real estate CRE, and insurance, corporate, or sovereign guarantees. Funding requirements are unique to each project, and it's important the projects have the necessary collateral as it allows CIG Capital to mitigate the risk and fund the majority of the capital stack. Here are some examples of general collateral requirements based on project types. Energy, utility, or infrastructure projects would require future agreements, insurance protection. Short-term projects, letter of credit, credit insurance, construction insurance. Traditional CRE projects, commercial real estate, structured finance. government projects, high LTV. So what are the potential downsides? A potential downside of funding the majority of the capital stack with one lender would be the percent of equity required by the lender. To mitigate the risk of providing funding, the lender could require a percentage of equity ownership. Some project owners prefer to not give up any amount of equity or may not want to give up the amount required in fear of giving up too much control. If the project defaulted on the loan, the project owners would be on the hook for paying back the entire loan, whereas private investors or angel investors might have different payback terms. If you're interested in learning more about CIG Capital's 100% project funding model, please visit our website at cigcap.com for more information.